So management companies have diversified sets of clients. They manage defined benefit and defined contribution plans, endowments, insurance companies, mutual funds, and high net worth individuals. So it's possible that investment decisions that maximize the value of the company as a whole may differ from those that maximize the values of individual clients. But the question is, do management companies display favoritism towards some of their clients or products at the expense of others? For example, which products may be more important? You can have these star products, high-profile products with that positive spillover effect, young products which are more sensitive to early performance, products or clients with different attentions, products that are held by households versus products that are held by institutional investors. And you can also have different client power. It could be direct, such as size, or indirect, such a form of connections. What are the possible benefits? So we know that management companies receive fees for asset under management, so you can have that increase in asset under management, and we know that flow convexity relation. And you can also have other forms such as reputation. The literature that is most related to what we do here, Gaspar, Mesa, and Matos, they look at mutual fund families, and they provide evidence of strategic performance allocation toward high family value funds, such as star funds, high fee funds, and young funds. Recently, Chaduri, Ivkovic, and Transinka, they look at institutional money management products. They also provide evidence consistent with strategic performance allocation towards star products and young products, and it varies with the client power. Another angle for that, Goncalves Pinto and Schmidt, they talk about co-insurance. In their paper, they show that mutual fund families coordinate internal trades in order to protect member funds that are suffering heavy redemptions. And again, you can see the benefit to the family over that. So these are compelling results. But still, there are at least two reasons why further investigation may be warranted. So first, due to lack of availability of transaction-level data, the analysis is usually conducted using returns, which are aggregated across time and across securities. Second, when you think about the mechanism, how that happens, the literature suggests two mechanisms, which is IPO allocation and cross-trading. And it's not clear whether if they occur frequently enough to explain that performance, or if there are other previously unidentified channels. So what we do here, we have data which allow us to directly test the existence of such behavior using daily trades. We have 13 F management companies trades on behalf of their institutional clients. This data is provided by Anserno, formerly known as Abel Noser. So we know, for example, that management company X traded for clients A, B, and C using brokerage firm Y. These are dedicated portfolio managers, portfolios. It's important to keep that in mind. Management companies make the call for their institutional clients. What we would like to do here is first provide direct evidence, will be consistent with strategic performance allocation, and introduce a new channel, new mechanism that was ignored or couldn't be tested before. Okay, so if you read through management companies' ADV filings, Form ADV, they mention that they find it convenient to bunch similar trades together across clients, and they use that through their trading desks. They say that they might use a single broker or multiple brokers depending on trade size. Clients may receive the same price or different prices, but importantly, management companies mention that you shouldn't expect to find systematic differences across clients. So we specifically target these bunch trades. How we do that? We look at trades by the same management company, same day, same stock, same trading directions for more than one client. And why we believe that is good? Because first, when we observe the data, when we look in our data, we see that there is a high degree of overlapping trades for clients within the same management company. So that seems to be an integral part of the daily trading activity compared to cross-trading or IPO allocation. And second, we think that we are able to control for unobservable variables such as stock picking ability because we look at the same stock, same day, brokerage talent and trading desk skills because it's the same trading desk of the management company. So just to show you very briefly how it works, you have a delegated portfolio manager. Suppose that you have 3 institutional clients. Suppose that the management company wants to buy Apple to 3 of its institutional clients. What they do, trading desk have the order, and they contact a brokerage firm to execute the trade. Let's say the ticket went to the broker worked through the trade, and suppose that after the execution, this is the prices that the broker has received executing that trade. He brings back these trades to the trading desk of the management company, and by the end of the day, the trading desk will need to allocate back these trades to the custodian banks of these institutional clients. How to do that? They might give a random order. If that was the order of the trade throughout the day, they might give that order, or they might decide to give the clients the same price. And we call that the same price benchmark. So basically what we do here, we create a measure. So for each bunch trade and each client, we create a measure which we call PTV, profit to dollar volume. How we do that? For each client, we have the number of shares, and we compare the actual execution price to that same price benchmark. We make sure to adjust if it's a buy or sell, just to make sure that we get the right direction, and we normalize that by dollar volume. Okay, to give you a specific example from our data, in that example, we have one management company on the same day, January 1st, 2010, same stock for 5 different institutional clients. You can see the number of shares that each client has received, and the price, the execution price, and very easily we can come up with the same price benchmark. We look at the total volume of that trade, total number of shares, and we get that same price benchmark. So if you calculate one example for the first client, that client had 500 shares. The execution price was lower than the same price benchmark. It's a buy trade, so it's a positive thing. In that case, that client on that specific trade got roughly 10 basis points. So what we do, we compare prices that client received to that same price benchmark. We calculate their hypothetical percentage of gains or losses per dollar volume. And we do it at the monthly level because our analysis will be conducted monthly. And then we explore whether these differences are systematic and test our hypothesis. Okay, so what are our hypotheses? So the null hypothesis is that there are no systematic differences across clients. If everything is random, you shouldn't expect to find anything. If this is rejected, our main hypothesis is that strategic performance allocation hypothesis, where systematic differences across clients are driven by strategic performance allocation. And our alternative hypothesis, the alternative story, is these systematic differences, if we find them, are driven by different trading practices and not favoritism. What our questions are, so for the first hypothesis, we first want to know if there are systematic differences. So first, do some clients receive systematically better or worse prices? And we're also interested to learn what is the economic magnitude of that possible channel. As for the other hypothesis, what are the characteristics of the management companies and clients likely to be involved? We want to see if this is consistent with what we would expect to find, and what are the direct benefits to the favoring management companies and benefited clients. As for the alternative hypothesis, we'll explore alternative explanations which are consistent with different trading practices. Okay, so before I go to the data and talk a little more about what we did, let me just give you a brief summary of our main results. So first, does it happen? We find systematic differences between clients in general in our sample and between clients within a subset of management companies. So we call that subset of management companies where we find statistically significant differences between their clients the significant managers group. And the other group is the non-significant manager group. So for that significant manager group, we find strong evidence of out-of-sample persistence in what we think is price allocation. The magnitude of that channel could be as large as 50 basis points, and we believe that this is a lower bound, and I'll say a few more words about that toward the end. As for the characteristics and the benefits, we find that management companies with more trade opportunities are more likely to be in that significant manager group, we find that clients with more trade opportunity and higher tension are more likely to be favored. As for the benefits, we find for that significant manager group increase in volume by favored clients. And we find it only for that specific significant manager group. When we look at clients' direct benefits, when we compare their trading gains to their counterparts, we find a difference of 15 basis points per month. As for alternative explanations, we show that our results are not driven by directed brokerage arrangements, price impact, trade commissions, trading styles, and fill ratios. And if we'll have time, I'm going to talk a little more about these alternative explanations. OK, so the data is on Cerno institutional trading data by delegated portfolio managers. Importantly, we don't have the holdings. We only have their trades. It starts in 1999, and it ends in 2011 in the third quarter. And the reason for that is Cerno stopped providing us the linking codes from that time that are important to our analysis. Main variables, we have the number of shares per trade, a buy or a sell indicator, so we know exactly if a trade is a buy or a sell, execution price, trade commissions, and QSIPs and tickers where we match the data to CRISP to get the rest of our variables. Other identifiers, we have the client type, and Cerno's clients are mainly pension plan sponsors and mutual fund families. We have unique numerical codes for the clients, management companies, and brokers that allow us to track these over time in our sample. And importantly and crucial to our analysis, we received linking codes from Cerno, which enable us to link institutional clients to their management companies and brokers. Okay, so when we look at the data, we started to look at the data, we find a very rich link structure. If you have these management companies, and of course they have multiple institutional clients. But we also have, if you look, for example, at client number 3, we observe that client number 3 has more than one management company managing its portfolio. And it's very common for the pension plan industry to have these multiple relations. And we believe it's a nice setting, this structure, to test our hypothesis. As for the data, we do observe the partial trades throughout the day for each client, but unfortunately the timestamps are not reliable, so we do our analysis at the daily level. We aggregate the information at the daily level, so the basic unit is a management company, client, day, and stock. And we have roughly around 6 million daily trades in our sample. Of that bunch sample, that accounts roughly for 50%, equally weighted from the total trades of each client manager pair, and these ratios are much higher for the cases where it happens. For these significant clients, we see that this bunch sample is more significant. The manager day stock level, the bunch unit level, we have around 2 million unique trades, which translates roughly to, on average, 3 clients per bunched trades. Other statistics, we have roughly around 500 management companies. These are 13F level management companies. Around 800 institutional clients, which translate roughly to a little more than 5,000 manager-client pair. And again, we have these multiple links to keep that in mind. On average, we have 27 months of bunch trading activity per manager-client pair. Additional interesting statistics, on average, we have a little more than 5 clients per management company in our sample. We have roughly 3 management companies managing institutional portfolios. As for trades in a month, we have, on average, 46 trades per month. And we have roughly 21 different stocks monthly in our bunch sample. Another interesting variable is the overlap ratio. And we measure the overlap ratio, how many of my trades are shared with at least one other institutional clients within the management company. This ratio is very high. Equally weighted is roughly around 80%. And this is consistent with Elton, Grober, and Green, and Blocker that show that overlapping trades for management companies. Number of intradaily partial trades that takes to execute a trade. Roughly, we have, on average, 5 different partial trades to execute a ticket, which means that these trades are fairly large, and this explains why we should expect to find different prices when brokers execute their trades. So how we start? First, we look at significant PTV averages across clients, generally in our sample. So for each manager and client pair, that is the unit, we calculate the time series average of the monthly PTV series. Okay, so we have clients with different frequencies in our sample. Some appear 2 months, some appear 6, some appear throughout the sample. So we do the analysis for different frequencies to show that that doesn't drive the result. This table is just for clients that appear at least 6 months in our sample. And we'd like to check the significance, and we have different p-value cutoffs. Okay, and importantly, it could be that these averages are not normally distributed, so we would like to account for that. So to account for such non-normality, what we do, we randomly reshuffle clients in each bunch trade, create that simulated distributions. We do that 10,000 times. We get the entire simulated distributions, and then we take our nominal p-value and see where that is located in that distribution, just to make sure that it's not inflated by this non-randomness. So for example, if you look at the 5% cutoff, we observe double the amount of cases that would be expected under a normal random benchmark. So we also here we see that we have twice as much as randomly expected. And if we split that into positive significant cases and negative significant cases, in our sample, there's 40% more positive cases than negative cases. Next, we would like to explore the economic magnitude of that channel, and we do that in 2 dimensions. The first dimension is conditioning on the client's time in sample to see how that changes over time. And the second dimension is basically what happens if you have trades with more opportunity. How we measure that? So for each bunch trade, we can calculate a spread, a high to low spread within that trade. We do it at the monthly level. For each month, we split the trades to trades above the monthly high and low average and below. And probably trades above the high-low average are more illiquid and smaller stocks. Okay, so what do we have in this table? Just to explain that a little bit. We have the significant positive clients in blue, and we have the significant negative clients in red. Here we have the time in sample, basically based on the frequency of clients in sample. It ranges from 1 to 6 months up to more than 60 months. And the other dimension is that we look at all trades and only at a subsample of trades above this monthly average high and low. Okay, so one first thing to note, we can see that these magnitudes are much larger for clients at the beginning of our sample. Okay, you see that the magnitudes, if you're in your first year roughly, is roughly around 13 basis points. The standard deviation is fairly big, so we have lots of variation. So this is consistent with the fact that probably the incentive to subsidize the favored client are strong when their clients are new. And also, management companies probably avoid exploiting specific clients for extended time period. So only observing the fact that these magnitudes shrink over time, for that evidence it seems to be more consistent with the fact that is related to favoritism and not trading practices, because if it's driven by trading practices, why these magnitudes will go down over time in our sample. Second thing, if we look at trades with more opportunity for the same clients, if we just look at the subset of sample, the magnitudes are much larger if you just look at the subset of where you have more opportunities. Now the magnitudes is roughly around 30 basis points, which that means that probably more opportunities are translated into larger transfers. Okay, next we explore what happens within a management company. We like to search for each management company. We calculate the difference between the top and bottom clients to see if we find statistical differences between their clients. We do that based on the client's PTV averages, and we admit this is an in-sample test because we rank within the sample and we check for differences. But if we cannot find anything using an in-sample test, we probably will not find anything with an out-of-sample test. So we start with that. Again, this table is for clients that appear at least 6 months in our sample. And again, here it's really important to account for that non-normality because we pick the mean and max, so this is not normally distributed. So what you can see here is that our simulated p-values really shrink that magnitude. And again, if you observe at the 5% cutoff, we observe 3 times the amount expected under a random allocation benchmark. So what we do here, for that subset of management companies where we find statistically significant differences between the clients, we call them the significant manager group. And we call the other management companies the non-significant group. And we'll use that separation to do our analysis. Okay, so let's go to some out-sample tests to see if it happens out of sample and it's not just an in-sample result. We do repeat the same thing for each month and management company, we use a rolling window to rank clients based on their PTV averages. We rank them to quartiles. The first quartile is the lowest, the bottom one, and the fourth is the top. And again, we use the difference between the top and bottom clients to split management companies into significant management companies and non-significant management companies. And what we do next, we repeat everything out of sample, we re-rank out of sample, and we would like to see what happens to changes between the quartiles. What I mean, for example, if you have perfect persistence, if I'm a client in the lowest quartile, I would expect that client to stay in the lowest quartile, or in the fourth quartile, I would expect him to stay in the fourth quartile. If it's completely random, I'll have an equal chance to appear in one of the quartiles over the next period. The average will be 2.5. Okay, so if we graph, that is exactly what we find. On the x-axis, we have the ranking quartiles. On the y-axis, we have the post-ranking averages. If you look at the red line is for the non-significant managers. It's roughly completely flat, around 2.5, which means even if you thought there is some persistence, it's completely random. Nothing is really there. For the green line, which is a significant measure group, we can see that persistence. On average, if you were at the lowest quartile, you will stay in the lowest quartile, and vice versa. And we repeat that also with cross-sectional regressions, and everything is statistically significant in our test. Another nice test is to see what happens to the magnitudes over time. What we do here, we basically split for each management company. We split the clients into two halves. We rank them by their first half, and again, split the sample into significant cases and not significant cases, and then see what happens in the second half of the sample. Do we see persistence or not? And the interesting result is, of course, if you just rank randomly, you will find similar magnitudes. If you look at the significant group and non-significant group, in the ranking period, they seem to be similar. But when you look out of sample and the second part life of their clients, what is interesting to look at these magnitudes in the post-ranking period. And the blue box represents the persistent ratio, how much these allocations are in the same direction. Interestingly, for the non-significant group, it even reverts, and it's not significant, so nothing is there. Everything was actually completely random. But for the significant measure group, you see that there is a high level of persistence, and everything is highly significant. If we limit ourselves to the sample with more opportunity, these persistence ratios are even much larger. So this, again, to show that there is something there for that significant management group. Okay, so hopefully I convinced you that it's not random. There is a subset of management companies where you find that significant differences. We've already seen some evidence that might suggest that this is consistent more with this price allocation, but let's look next at the characteristics of the significant management companies and their clients. So what we do here, we basically run a Fama-Macbeth probit models. So we run monthly probit models. And we assign the value of 1 if you appear in the significant manager group. And we assign the value of 0 if you are in the non-significant manager group. And we check different variables that we can use using Uncerno to see what affects that likelihood. So the first set of variables are variables that relate to opportunity. If I have a higher shared volume across my clients, higher degree of overlap ratio in trades between my clients, and more stocks traded across different industries are more likely to be in that significant manager group. The other two interesting variables are, of course, the number of clients per manager and the average number of management companies per client. Remember, we have that rich structure. We first tried the linear specification, but a nonlinear specification seems to be to explain more. What we do here, we look at the variable and the variable squared to try to capture that nonlinearity. All coefficients load significantly, and we want to explore is how that changes with our variables. Importantly, it's hard to infer from that coefficients what is going on because these are coefficients and not marginal effects. And second, usually when you predict probabilities, you look at the variables at their mean, but what we really want to do is to change the variable and see how that affects that predictability. And this is exactly what we do, okay? So what we do basically, for each variable of interest, we set all other control variables to their mean, and we vary our variable of interest and plot that predicted probability. Okay, so for the first variable, these are the number of clients per manager, how many clients a management company has. On the x-axis, we have the number of clients. That ranges based on the sample range. And on the y-axis, we have that predicted probability. And what you can see here, it's indeed, it's nonlinear, and it's very interesting. When you increase the number of clients, when you have more clients, there is a higher likelihood for you being in that significant manager group. Probably you have more opportunity, more clients that you can probably, you have this channel. But at some point, when you have more than management clients in your sample, these probabilities tend to go down. Maybe you have less incentive to engage in that price allocation. Second variable is the numbers of management companies per client. How many management companies managing the portfolios of my client besides me? Okay, again, on the x-axis, we have the number of managers per client. And again, what is interesting here, this is flat at the beginning, but at some point, if your clients have too many management companies managing their portfolios, probably, again, your incentives to engage in that are lower because probably it will be hard to attract volume from these clients. And we also explore the clients. What is the probability of being a favored or a disfavored client? Of course, the incentives to favor or disfavor clients could differ. So what we do, we split the sample into positive clients and negative clients. And we do that based on the average measure in the sample. And of course, within subsample, we have significant cases and non-significant cases. So what we do here, again, we do these probit models, monthly probit models. We assign the value of 1 if you are a significant positive or significant negative client, and we assign the value of 0 if you have a non-significant result. And again, we want to explore what can explain that predictability. So the first variable is the relative volume in a bunch trade. This is kind of mechanical because if you have more shares in a bunch trade, your price will probably converge to that same price benchmark, so this loads in a negative way. Other variable for opportunities, overlap ratio, how my trades are overlapped with other clients. That seems to load positively for the positive clients. If you have more overlapped trades, more opportunity, you have a higher chance to be in that significant group. Other variables which correlated with opportunity, if you trade more illiquid stocks or small stocks, that also increased the likelihood of you being in that significant group. And the last variable, which again relates to how many management companies managing my portfolio. So we'd like to learn how that affects the probability of you being a significant client. And again, we plot these predictive probabilities. We have that for the positive clients, and we have that for the negative clients. Interestingly, when you look at positive clients, it seems that when the number of management companies managing your portfolio increase, you have a higher chance being a favored client. Probably then the management company would like to compete for your volume, and at some point when you have too many management companies managing your portfolio, that predictability decreases. Probably management companies will have less incentive to compete for your volume. And for the negative clients, we see the opposite effect. It is less dramatic, maybe because part of the costs are probably shared across different clients. It's almost flat at the beginning. At some point, when you have too many management companies managing your portfolio, your attention is probably low. You probably don't notice that, and you have a higher chance being in that negative significant group. And finally, as for the benefits, do we find benefits to the management companies and clients? So for the management companies, we find an increase in volume. So we use our sub-period analysis. We would like to see what happens to the client's volume between the 2 times of the sample. What we find only for the significant manager groups, we find an increase of 15 to 30% in trading volume by the favored clients. So it seems that indeed, management companies manage to increase their asset under management by these clients. And we don't find anything for the non-significant group. There is no change in volume, difference in volume for the non-significant group. As for the clients, for each client manager pair, we calculate what we call a monthly trade gain measure because we only observe their trades. We compare the positive and negative clients to their counterpart. And what we find positive and significant difference in performance of 15 basis points per month between the positive clients and their counterparts. So there seems to be a benefit to these favored clients. Importantly, we don't find any result for the negative clients, which means that probably, again, the costs are shared probably across the negative clients, and that doesn't translate into significant differences between their performance and their counterparts. Okay? So now what we do in the last part of the paper, let's try to rule out that all these results are not driven by these alternative explanations that might be driven by different trading practices. Okay, so the first and important one is directed brokerage arrangements. Clients may direct managers to execute their trades with specific brokers. And if you read management companies' ADV filings, they say that if this is the case, management companies may not be able to deliver the best execution price. So what we do here when we repeat our analysis, our entire analysis, but instead of looking only at manager client day in stock, we also limit ourselves for trade executed by the same broker. And we basically find the same thing. The results are qualitatively similar. So results are not driven by that directed brokerage arrangement channel. Second thing, maybe you have some dynamic compensation scheme. Maybe management companies take trade commissions into account. Okay, so in that case, clients who pay higher commissions may be compensated through better execution prices. Maybe that is what's going on. So what we do here, we directly compare trade commissions and PTV averages and see if there is a relation. How we do that for each management company, we rank by commissions and then look at PTV averages, or rank by PTV averages of our clients and look at trade commissions. Importantly, I don't want to spend much time on this. No matter how you do that, we don't find any differences. So trade commissions doesn't seem to derive our result. Third explanation, maybe client heterogeneity within management company might lead to different execution practices. Maybe that explains our result. The first thing that we test for size and price impact. Because it could be that clients who are allocated larger quantities mechanically be allocated worse prices, be last in line because they might cause that price impact. So what we do, we conditioning on the management company, we look at the correlation between trade size and execution price and see if we find any relation. Importantly, we couldn't find any significant result. So price impact or magnitude of trade doesn't seem to derive our result. Second, you can have different portfolios, unique strategies. Clients whose overall portfolio differ may receive different attention in a given bunch trade. How we do that, we look at two measures. The first measure by Daniel, Greenwald, Tintwan, and Wormers. We rank clients, we rank portfolios based on their size, book to market, and momentum. We check the 3 dimensions to see if we can find any differences. And we look also at the trading style measure recently proposed by Annan Irvin, Puckett, and Van Kotterman. And importantly, we do not find any statistically significant differences between significant and non-significant clients within the management company. So that also doesn't seem to derive our result. Finally, you might have different fill rates. So different execution practices may lead to different fill rates. For example, you might have a client number 1, which might have 90% fill rate in this bunch trade on day 0 and 10% on the following day. You also might have client 2, for example, that has 50% fill rate on the first day and 50% on the other day. So in that case, such a difference may suggest that the clients are different in their trading needs, and this is exactly what explained our result. Importantly, we do not find statistically significant differences between the significant and non-significant clients. So fill rates, again, doesn't seem to derive our result. Okay? So let me just conclude. So as for the contribution of our paper, we use trade level data to provide direct evidence of price allocation by a subset of delegated portfolio managers. And we reveal a new mechanism that was ignored or couldn't be tested, and we believe that that mechanism is kind of an integral part of the daily trading activity given the high degree of overlap trades across clients. Overall, we find strong evidence which indicates that there are systematic differences across clients for a subset of management companies. Second, the magnitudes are economically significant, can be as large as 50 basis points per trade volume. And we believe that this is a lower bound because first, we only observe a subset of institutional clients. We don't have all institutional clients. And second, these clients that subscribe to Anserno are usually more tuned to their trading costs. We explore the characteristics of the management companies and clients likely to be involved, and we provide evidence of the benefits. Finally, we rule out these alternative explanations. As for future research, we're going to explore other channels, such as trade allocation, which means that management companies might allocate different quantities based on end-of-day prices. Okay, so that's it, and thank you very much for your attention.